The Oracle and the Philosopher, 6 timeless lessons from Buffett and Munger that built an $800 billion fortune. In 1959, a 29-year-old stockbroker from Omaha sat down at dinner with a sharp-tongued lawyer from Los Angeles. Neither of them knew it at the time, but that single meal would spark a partnership worth over $800 billion. Buffett and Munger didn't just build Berkshire Hathaway. What they built was a philosophy, a way of thinking about money and patience and life that almost anyone can use. So today, I'm breaking down 6 lessons from their partnership. The same principles the world's most successful investors and institutions apply every single day. And they work just as well for you and me. So a quick thing before we get into it, I'm building this channel to be investing education that I never had and I wish I'd had 10 years ago. Just real principles broken down so anyone can use them. If you get value from this channel, please hit subscribe. It costs you nothing and it helps more people find the content. So rule number 1, don't lose money. Buffett has one rule above everything else. Rule number 1, never lose money. Rule number 2, never forget rule number 1. Now, people think it's a cute saying. It's really not if you think about it. If you lose 50% of your money, you don't need 50% to get back to even. You need 100%. And that's the maths of loss. It's why investors like Howard Marks at Oaktree Capital have written entire books about managing downside risk, even before thinking about the upside. These are some of the most successful firms on the planet, and it all starts with protecting your capital. So think about 2008. The S&P 500 dropped 57%. Millions of people panicked and sold. They locked in their losses. But Buffett, well, he bought. He put $5 billion into Goldman Sachs on preferential terms. He bought Burlington Northern Santa Fe Railway. Everyone was running for the exit. He was deploying his capital. The lesson is to protect your capital above all else. In the capital framework we use at Capitalizt, this is the foundation of what we build. Before we look at the upside, we ask, what can go wrong? How much money can I lose on this investment? It's the same question that the best capital allocators ask before every major decision. Protect the downside and the upside handles itself. Lesson 2 is all about the circle of competence. Late 90s, everyone was getting rich buying tech stocks. Amazon, Cisco, Yahoo. Newspapers literally called Buffett washed up. What was his response? I don't understand these businesses. He didn't try to fake it. He didn't FOMO into buying stocks he couldn't evaluate. He stayed in his lane. What was his lane? Insurance, banks, consumer brands, businesses he could understand inside out. When the dot-com bubble burst, those tech stocks crashed 80 to 90%. Buffett's portfolio barely flinched. He didn't predict the crash. He just refused to play the game he didn't understand. Munger put it perfectly. Knowing what you don't know is more useful than being brilliant. The great investors always understood this. They define where they operate, they stay disciplined within those boundaries, and they don't need an opinion on every stock. Deeply understanding 5 to 10 businesses and only investing when the odds are overwhelmingly in your favor is probably the best approach that you can take. Now, lesson 3 is about temperament over IQ. Buffett once said something that really stuck with me. Investing is not a game where the guy with 160 IQ beats the guy with 130 IQ. What you need is the temperament to control those urges that get people in trouble. One proof, long-term capital management. A hedge fund run by 2 Nobel Prize winners is a great example. They built models that were supposed to be unbeatable. In 1998, they nearly collapsed the entire global financial system. The Federal Reserve had to coordinate a bailout. Genius level IQ, 0 temperament. Compare that to March 2020, COVID hits, market crashes 35% in 3 weeks. Most people panicked, sold at the bottom, locked in their losses, but the long-term investors who stayed the course did nothing. They were rewarded for it. The people who lost money were the ones who let their emotions make the decisions. Now, Munger said he and Buffett succeeded because they were more rational. Every market crash wasn't a crisis to them. It was a sale. That's the temperament that the best capital allocators share. Lesson number 4, the power of compounding. Warren Buffett is roughly worth $130 billion. 97% of that wealth was made after his 67th birthday. He started investing at the age of 11. By 30, a millionaire. By 50, about 400 million, but the next 40 years is where the power of compounding came into its own. That's when he moved from 400 million to 130 billion. That is what most people miss. They want to trade quickly. They see people on social media flipping meme stocks and think about how wealth is built. Look at the biggest sovereign wealth funds, Norway, Abu Dhabi, trillion-dollar pools of capital, and their entire strategy is built on patient long-term compounding. If it works at that scale, it should tell us something. Munger said the first rule of compounding is never interrupted unnecessarily. Every time you sell in a panic, you reset the compounding clock. Patient capital, long time horizons, let compounding do the heavy lifting. Lesson 5 is all about the margin of safety. You're driving a truck across a bridge. The sign said it holds 10 tons. Your truck weighs 9.9 tons. Would you actually drive across? Probably not, right? You'd want that bridge to at least hold 15 tons, which is your margin of safety. That's how Buffett and Munger invest. They never pay full price for a stock. They wait until a great company is trading below what they believe it's worth, and then they buy it. Benjamin Graham, Buffett's mentor, laid this out in The Intelligent Investor over 70 years ago. It's one of the most enduring principles in the history of investing, and the best allocators still follow it rigorously. You will be wrong sometimes. Every investor is. Even Buffett got it wrong with Tesco and Kraft Heinz. The question is whether your mistakes destroy your portfolio or just dent it. In our capital framework, this is the A for asymmetry. We look for investments where the upside far outweighs the downside. Now, lesson 6 is all about the power of partnership. It's my favorite. When Charlie Munger passed away in November 2003, weeks before his 100th birthday, Buffett said Berkshire Hathaway could not have been built to its present status without Charlie's inspiration, wisdom, and participation. Just think about that. The most successful investor alive admitted he could not have done it alone. Jobs had Wozniak. The greatest wealth creators of all time had someone to sharpen their thinking, to challenge them. When Buffett wanted to buy cheap companies, Munger pushed him towards quality. Forget what Warren told you about buying fair companies at a wonderful price. He said, buy wonderful companies at a fair price. That shift led Berkshire to stocks like Coca-Cola, Apple, American Express, and companies with durable advantages that compound over decades. My advice to you is find your Munger, someone who tells you the truth. The quality of your thinking depends on the quality of the people that you listen to and surround yourself with. So, one dinner, two men who thought very differently, over 60 years and more wealth created than the GDP of most countries. None of these lessons require a fortune. The most successful investors in history have applied it to their own investing. They didn't have a secret formula. They had discipline, they had patience, and most importantly, they had each other. And that's the edge. So before you go, I've built a completely free wealth assessment. A few questions and you'll get an 11-page personalized report showing you exactly where you are right now and what you need to do to get to the next level. The link is in the description below. Just take 5 minutes and complete the assessment for yourself. If this video gave you something to think about, please hit subscribe. We're building a community of long-term capital allocators. Drop a comment. Which lesson hit you hardest? And which investor should I break down next? Peter Lynch, Howard Marks, whoever else. I'm Ravi Naika, the Capitalist. If you don't win, make sure you don't lose. I'll catch you on the next one.